Welcome to the Deep Dive. Today, we are cracking open a document that maybe at first glance seems a bit dense. The 2016 Shareholder Letter from Goldman Sachs.
That's right. We've got the letter itself and a set of questions really guiding us through the main themes.
And our mission today is basically to pull out the most important insights for you. The performance story, the challenges they face, their strategic moves, and, well, what the folks at the top are thinking about the future.
Exactly. We want to give you that well-informed perspective without getting totally lost in the weeds or, the financial jargon.
Think of it like getting the executive summary, but with a bit more personality and maybe uncovering those surprising little details you might miss just scanning it.
Okay, let's get into it.
So the letter kicks off describing 2016 as a tale of two halves. What was the overall picture of the firm's performance that year?
It was definitely defined by that phrase, a tale of two halves.
Yeah.
Just like 2015, they said, but crucially, the order was reversed this time.
Reverse. So does that mean the first half was rough?
Extremely rough, yeah.
Yeah.
The letter notes a really difficult start to the year. Net revenues were down significantly, 28% year over year, and Q1 was particularly bad, down 40%.
Wow, 40%.
But then the second half saw a pretty strong rebound. Net revenues were up nearly 16% compared to the second half of 2015.
It's quite a swing within just 1 year. So how did it all, net out for the full 12 months?
For the full year, they landed with net revenues of $30.6 billion. Net earnings of $7.4 billion, and diluted earnings per share came in at $16.29.
Okay. And the ROE, the return on equity?
Their return on average common shareholders' equity, ROE was 9.4% for the year.
What kind of environment were they operating in that made that first half so challenging? What were the major headwinds they pointed to in the letter?
While they explicitly call out a volatile global economic environment, there were, real concerns about global growth early in the year. Some people were even predicting a potential recession.
Right.
And added to that were some unexpected geopolitical events that definitely shook the markets. Things like the Brexit vote in the UK and, of course, the outcome of the U.S. presidential election.
Yeah, those certainly weren't on many people's bingo cards for the year. Despite all that turbulence, what did leadership emphasize as, key accomplishments or things they really focused on?
Well, amidst all that, they highlighted staying focused on their clients' needs, number one. Also, operating the firm, efficiently managing costs, and, importantly, continuing to invest in the business for the long haul.
Okay. Let's shift to the voice of the letter. It came from Lloyd Blankfein, who was chairman and CEO then. The letter also mentions David Solomon and Harvey Schwartz being named presidents and co-CEOs during this period. What were Blankfein's main messages coming through?
You really get a sense of a focus on, let's say, resilience and control. He stressed the need to be nimble, flexible in a changing world, and to concentrate on the things they could actually control internally.
Makes sense.
He talked about managing the firm with discipline while preserving what he called optionality for upside, which basically means being ready to capitalize when conditions improved. And the value of their diversified client base was definitely a recurring theme.
What kind of leadership philosophy does that reflect? Adaptability.
Yeah, adaptability seems paramount. Also, a really clear and consistent focus on client service, operational discipline, that commitment to long-term investment even when times are tough, and, that strategic foresight to prepare for both downturns and potential upturns.
How did they position themselves against their competitors in this kind of environment?
Well, the letter positions Goldman Sachs as one of a maybe relatively small number of global firms that stayed fully committed to serving client needs across a really broad range of financial products, services, and geographic regions.
Right. Implying others might have pulled back.
Exactly. It implicitly contrasts their approach with other firms that might have scaled back in certain areas during that period.
And the overall tone of the letter. Given that difficult start, did it feel defensive or optimistic or...
That's a good question. While they were definitely transparent about the challenging first half and the external pressures, the tone, I'd say, is one of resilience and confidence in their strategy. They also expressed quite a bit of optimism about the potential for improving market conditions and policy changes down the road, especially after the U.S. election outcome.
Okay, let's move beyond the top-line numbers. The letter goes into quite a bit of detail about financial discipline, particularly costs. How did their revenue and profit actually compare to 2015?
Well, for the full year 2016, net revenues ended up being down 9% compared to 2015, and compensation and benefits expenses were down a proportional 8%.
And they took specific actions on costs because of that tough environment,
Right?
right?
Absolutely. They noted taking actions consistent with those difficult conditions. A really striking example they gave was in that rough first quarter when revenues were down 40%, while they also accrued compensation and benefits expenses 40% lower.
Wow, that's a direct link. What about bigger sort of structural savings efforts?
Yeah, they highlighted completing an initiative that identified $900 million in annual run rate compensation reduction. They actually realized about $500 million of those savings, net of costs, in 2016 itself.
Okay.
And looking back even further, since 2011, they mentioned they'd announced and completed a total of $2.8 billion in these kinds of savings initiatives.
And they used 2011 as a comparison point, didn't they, to show the impact of this discipline? What did that comparison show?
It really underscored the efficiency gains they felt they'd made. You see, 2011 was also a challenging year for revenues. But in 2016, despite having higher net revenues than 2011, their operating expenses were actually 10% lower.
Interesting.
Yeah, and their compensation ratio was down 400 basis points, and their pre-tax margin was more than 12 percentage points higher compared to 2011. So that comparison really highlights the significant operating leverage they'd built into the business structure.
Efficiency wasn't just about, say, cutting headcount or compensation, though. They also mentioned things like location strategy, right? Like
Yeah.
their growth in Salt Lake City.
Yes, exactly. That's another piece of the efficiency puzzle. The letter mentioned growing their headcount in Salt Lake City by nearly 80% over the 5 years leading up to 2016, making it their fourth largest global location. It's about optimizing their footprint, their talent base, where people are located.
Okay. Let's switch gears a bit to risk, regulation, capital, liquidity, always core concerns for a major bank. How did the firm address managing risk in the letter?
They framed risk management within that broader theme we talked about, discipline and preparedness. Specifically, managing the firm conservatively and actively preparing for potential downside scenarios. It's really about being ready for whatever the market might throw at them.
And on the regulatory side?
They discussed the ongoing process, which it was, of adapting to the significant new regulations that came into effect after the 2008 financial crisis.
And what was their take on those post-crisis regulations, like Dodd-Frank? Did they offer a view?
The letter contains a pretty clear statement here. It says that as a result of all these regulatory adjustments, the firm and the broader financial system are, quote, safer.
Safer. That's a pretty definitive assessment from inside the industry. How did they describe their own balance sheet strength, their capital and liquidity position?
They stated their balance sheet had, and this is another quote, never been more conservatively positioned. And they backed that up with some striking numbers. Their global core liquid assets, that's the highly liquid stuff they can access quickly, had increased almost 4 times since 2007.
4 times, wow.
Yeah, and their common shareholders' equity, basically the owner's stake, had nearly doubled. And their gross leverage, their reliance on borrowed money versus their own capital, had been cut by more than half over that same period since 2007.
And they actually shrunk the overall balance sheet size.
Correct. It was down 7% over the 5 years prior to 2016. But, and this is crucial, while the balance sheet got smaller, they simultaneously increased common shareholders' equity by 13% and grew book value per common share by a pretty substantial 40% over that same 5-year time frame.
And this strong capital position presumably allowed them to return capital to shareholders.
Yes, exactly. Over those 5 years, they returned nearly $32 billion to shareholders through share buybacks and dividends. And this reduced their basic share count by roughly 20%, hitting its lowest level at that time.
Okay, let's dive into the individual business segments now.
Right.
Starting with investment banking. What was the story there?
Well, they describe having deep, long-standing relationships over 8,000 clients globally in this division. They highlighted ranking first in global announced and completed M&A transactions in 2016.
Okay, strong in M&A.
Right. Financial advisory revenues were down compared to a really strong 2015, but that was partially offset by a record year in debt, underwriting $2.5 billion in revenues there.
Debt underwriting. That's maybe an area where they haven't always been seen as like the absolute top globally compared to some big competitors.
That's a fair point, and the letter actually made a point of highlighting their performance here. They noted ranking in the top 5 globally in overall debt underwriting and top 3 in global high-yield debt. So it shows strength in areas that maybe were perceived as less traditional strongholds for them.
Right.
Equity underwriting revenues, though, declined significantly. That really reflected the challenging market environment we talked about earlier. But they did note a growing transaction backlog in equity underwriting heading into the fourth quarter, so maybe seeing some green shoots there.
Okay. How about institutional client services, or ICS? That's their big trading and sales division, right? Covering FICC, fixed income, currency, commodities, and equities.
Yeah, ICS. They described it as a diversified global platform, and they reiterated that commitment we mentioned earlier, serving clients broadly across products and regions, kind of implicitly contrasting themselves with others.
And FICC, specifically, had been facing some structural headwinds industry-wide for a while by then, hadn't it?
Definitely. You had low interest rates, a flat yield curve, sort of muted global growth. All that created less volatility and, frankly, less client activity. The letter was pretty firm, though, that they weren't drawing hard conclusions about the long-term importance of the FICC franchise based just on those cyclical challenges.
They still saw it as core.
Yes, emphasized its continued necessity for clients. They noted particular strength with hedge fund clients and also efforts to deepen relationships with traditional asset managers, citing things like market share improvements in areas like U.S. cash credit.
And how did the numbers look for FICC and equities within ICS?
Well, despite that difficult first half, FICC net revenues actually ended up slightly up year over year for 2016. Equities client execution revenues, on the other hand, declined significantly, which really reflected that lower activity environment.
Got it. Investment management is another core area what was happening there.
They described this division as one of the fastest growing active investment managers out there. Their offerings cover, everything from private wealth clients to large institutions and specialized fund products.
How are the financials?
Well, net revenues were down year over year, but that was largely due to lower incentive fees, which can be lumpy. The really significant story, though, was the underlying asset growth.
What was so notable about that asset growth?
This is where you see a key insight into their strategy, I think. Over the 3 years leading up to 2016, they grew assets under supervision by a massive $337 billion, reaching a record $1.4 trillion.
Huge numbers.
Huge. And crucially, $150 billion of that growth was what they termed organic, active, long-term net inflows. That means it was genuinely new money that clients actively chose to place with Goldman Sachs for the long term, not just market movements.
And that was unusual at the time.
Very much so. That's particularly impressive because many active managers across the industry were actually seeing clients pull money out during this period. So they saw this as a big opportunity for continued growth, by providing advice and innovative products.
Okay. What about investing and lending? This segment always feels a bit different from the others.
Yeah, it is a bit different. They described investing and lending as highly synergistic with the rest of the firm, though. It allows them to provide long-term capital directly to clients through both lending and equity investments, aiming for, strong risk-adjusted returns.
And was expanding their lending a stated growth opportunity.
Yes, it was definitely highlighted. About a third of their 2016 investing and lending net revenues actually came from debt securities and loans, including over $1 billion in net interest income.
So a growing source of income.
Right. And their funded loans grew substantially, 2.8 times over 4 years, hitting roughly $64 billion by the end of 2016. That was spread across corporate clients, private wealth clients, and real estate. They mentioned seeing increased demand for this kind of financing from their investment banking and private wealth clients, too.
And this segment was also home to the launch of something totally new for them back then, Marcus.
Exactly. Marcus, by Goldman Sachs. That launched in the fall of 2016. This was their big move into online consumer lending. They positioned it as an alternative for consumers burdened by high-interest credit card debt.
Why then? Why consumer lending?
Well, the firm saw an opportunity basically leveraging their historical strengths in technology and risk management within that growing digital finance space.
And who is the target market for Marcus?
They targeted credit-worthy consumers, typically with maybe $5,000 to $30,000 in existing credit card debt. They also pointed out the sheer size of the unsecured consumer loan market in the U.S., roughly $850 billion, indicating, a massive addressable market.
And the initial reaction?
Early feedback was reported as encouraging, and they definitely saw a potential for attractive, risk-adjusted growth in this completely new area for the firm.
The launch of Marcus is actually a great example of how central technology is to their strategy, something the letter explicitly states, right?
Oh, absolutely. It's called out directly as a core competitive advantage, something woven into really every part of their business. It drives value by improving the client experience, making operations more efficient, and, like Marcus shows, creating entirely new avenues for growth.
They also mentioned the Marquee platform. What's that?
Yeah, Marquee. That's their collection of applications designed specifically for institutional clients. It basically provides them with access to some of Goldman Sachs' own proprietary analysis, data, and risk management tools. It's kind of a way to share some of that internal capability externally with key clients.
Interesting. Where else was technology investment focused, according to the letter?
A big focus was on improving their electronic execution capabilities. This is super crucial for clients using systematic investing strategies, for algorithms that require speed and precision. But it also helps internally with straight-through processing, just making operations smoother and more efficient.
So, benefits across the board.
Yeah, they emphasized that investments in these electronic platforms had made their global infrastructure more capable of handling equity and select FICC transactions really efficiently, benefiting all types of clients.
And technology even played a role in how they approached hiring. That seems unusual to mention in a shareholder letter.
It is an interesting detail they included. They integrated tech like video interviews into their campus recruiting process. The stated goal was to widen and diversify their talent pool. For the 2017 intern class alone, they said they reached candidates from over 900 schools, which was apparently 100 more than the previous year.
And speaking of people, the letter really hammers home the point that their people are their most important long-term competitive advantage.
Yeah, they literally call it the perennial foundation of our success.
Strong words.
Definitely. The commitment to attracting and retaining top talent is presented as absolutely foundational. They also stress the importance of their workforce being diverse, representative of the countries and cultures they operate in. They noted employees from over 160 nationalities speaking over 100 languages.
The firm is famously competitive to get into. What did the letter say about their attractiveness as an employer back then?
They reported continued strong demand, maybe even growing. Summer internship and full-time campus applications apparently increased by 11% in 2016. That totaled about 130,000 applicants for roughly 5,000 roles.
Wow. Do the math on that.
Yeah, it's about a 4% hiring rate. Incredibly selective. Offer acceptance rates were also high, around 8 out of 10 accepting. And they didn't miss the chance to highlight their consistent recognition, like being named one of Fortune's 100 best companies to work for every year since that list began in 1984.
Given the focus on technology we just discussed, was there a particular emphasis on hiring people with STEM backgrounds?
Yes, they specifically noted that 37% of their new campus analysts hired in 2016 came from science, technology, engineering, or math majors. They even quantified their tech workforce, stating approximately 9,000 people, about a quarter of the whole firm, worked in engineering-related roles at that time.
And they emphasized the potential for long-term careers there, not just an up or out place.
That was the message. The letter noted the median tenure for partners and managing directors was 15 years, with nearly 60% having joined at the entry level. That definitely points towards significant internal career progression. They also detailed, extensive investment in training and development programs for employees at all levels.
The letter also touched on some significant leadership transitions during 2016 and early 2017.
Right. A very notable one was Gary Cohn's appointment as director of the National Economic Council under then-President-elect Trump. The letter acknowledged his many contributions to the firm over the years and expressed best wishes for his new public service role.
And that move obviously triggered other changes internally.
Yes, exactly. David Solomon and Harvey Schwartz were named presidents and co-QOs to fill that gap, and Marty Chavez, who had been the chief information officer, became deputy CFO and was set to become the full CFO shortly after the letter was published.
Were there also some significant senior retirements mentioned?
Yeah, a couple of vice chairmen, Michael Woody Sherwood and Mark Schwartz, both retired after long careers. And consequently, new vice chairmen, Richard Nod and Pablo Salame, were appointed, recognizing their extensive experience within the firm.
And a new member joined the board of directors, too.
That's right. Ellen Kullman, the former CEO of DuPont, joined the board. The letter highlighted her significant business leadership and board experience.
Yeah, the move of senior figures into government service, like Gary Cohn, that's something that has, let's say, drawn public discussion over the years regarding Goldman Sachs. The letter actually addresses this tradition directly.
It does, yeah. It notes that Gary Cohn wasn't the first senior figure to move into government service. They cited 5 recent predecessors who had done so. It frames this whole thing as a kind of long-standing ethic within the firm, a commitment to public service.
And the letter confronts the criticism, the idea that the firm might somehow benefit unfairly from this flow of people into government.
Yes, it explicitly acknowledges that criticism, the charge that Goldman Sachs might gain advantages, others don't because of these connections. However, its stated counterpoint is, and I think this is a direct quote again, the opposite is true.
The opposite is true.
Yeah, arguing that individuals moving into government roles actually, quote, bend over backward to avoid any perception of favoritism towards their former employer. The firm expresses pride in this tradition and says it encourages its people to contribute in public roles.
They also touched on speaking up on broader public policy issues, right? Things beyond just financial regulation.
Correct. The letter mentions contributing expertise on matters like fiscal policy and also speaking out on social issues that they feel affect their people and the firm's ability to attract and retain talent. It specifically cited their stances on issues like marriage equality and, more recently back then, immigration policy.
How do they frame that?
They framed it as expressing views on policies that impact their people, their business operations, and ultimately long-term economic growth. It's presented in the letter as being about factors affecting their ability to operate effectively and contribute.
Okay. Shifting gears one last time to their commitment to communities. The letter discussed a sense of responsibility that goes beyond just, writing checks.
Yeah, they emphasized using not just financial resources, but also their expertise, their networks, their knowledge to help tackle social and economic challenges.
What were some of the key initiatives highlighted in the letter from that time?
2 big signature initiatives stood out. First, 10,000 Women, which launched back in 2008. It provides business education and access to capital for women entrepreneurs, mostly in developing countries. By the end of 2016, they'd expanded this through a global finance facility with the IFC, the International Finance Corporation.
Okay.
They'd committed over $600 million through banks in 17 markets with the goal of enabling over 30,000 women entrepreneurs to get access to capital.
And the second one?
The other was 10,000 small businesses, which focused on the US and the UK. By the end of 2016, it had served over 7,300 small businesses across 31 sites. It offers management training, support with accessing capital, and general business support services.
And did they mention results?
Yes. The letter noted that independent evaluations consistently showed that participants in this program increased their revenues and created jobs faster than the broader economy.
And their firm-wide philanthropic fund, Goldman Sachs gives.
Right, Goldman Sachs gives. This is structured as a donor-advised fund where the firm's partners recommend which organizations receive grants. Since 2010, it had apparently made over 28,000 grants, totaling nearly $1.2 billion to over 5,600 different organizations.
What kinds of causes?
A really wide range. Supporting innovative economic solutions, addressing the Middle East refugee crisis, which was prominent then, STEM education for underserved youth, medical research, need-based financial aid globally. Pretty broad.
Okay. Finally, let's wrap up with their vision and outlook for 2017. What did Goldman Sachs project looking ahead from the end of 2016?
Well, the letter wisely cautioned, no one has a crystal ball and that markets are inherently unpredictable. They move in cycles. However, it did express some specific reasons for optimism heading into 2017.
What were those key factors giving them that positive outlook?
Well, one major factor cited was the outcome of the U.S. election. They felt it raised the possibility of more stimulative tax and regulatory policies, along with plans for increased infrastructure spending.
How did they frame that possibility?
The letter framed this as a potential substantial change in direction that offered reasons for optimism among investors and companies. They also noted, though, that broader economic growth was actually showing signs of improvement even before the election outcome. Another factor was the potential for U.S. interest rates to rise, as policymakers seemed poised to react to improving economic indicators, while other global markets might maintain steady rates or even continue stimulating. This potential divergence in monetary policy globally was seen as creating market opportunities.
So despite navigating a really challenging 2016, The letter concluded with a feeling of confidence in their strategy and the future.
Absolutely. They really reiterated their commitment to their core businesses, again, contrasting themselves with others who might have pulled back from areas like sales and trading. They expressed strong confidence in the strength of their client franchise, the transformation of their balance sheet we discussed, their prudent management of expenses and capital, and that significant operating leverage they felt they had built.
And the belief was this would pay off.
Yes. They believe this positioning would allow them to generate industry-leading returns and outperform over the long term, basically by staying true to their strategic focus.
So what does taking this deep dive into the 2016 Goldman Sachs shareholder letter really tell us? I mean, we've seen a year of really sharp contrast, right? The global volatility hitting hard in the first half, only to see a significant rebound in the second.
Yeah, it gives you a really direct look into how leadership at the absolute highest levels of global finance viewed their performance, the market challenges they faced, and their strategic response at that moment in time. You see that clear focus on discipline, particularly around costs, and their commitment to navigating market cycles while still investing in key areas like technology, specific business lines like lending, and of course, their people.
It is striking how they balance that rigorous cost control building, that operating leverage we talked about, with simultaneously launching something entirely new like Marcus and continuing to invest heavily in tech and talent.
Yeah.
That seems like a tough balancing act.
It is, and that tension between discipline for today and investment for tomorrow is definitely a core theme running through the letter. It shows, I think, a long-term perspective, even when they were facing pretty intense short-term pressures.
So consider this as we wrap up. The letter highlighted the firm's effort to build significant operating leverage through efficiency, while at the same time maintaining optionality for upside. What does that tension tell you about the importance of being both lean, maybe, and prepared to seize opportunities, whether you're running a massive institution or just charting your own course?
It's definitely a reminder, isn't it, that navigating unpredictable environments probably requires both careful management of the resources you have now, but also a willingness to invest strategically for what might come next, being ready for both scenarios.
Well, we hope this deep dive has given you some valuable insights into Goldman Sachs back in 2016 and perhaps sparked some ideas or questions for your own endeavors.